Anthony Valeri on behalf of the wealth management team. Thank you for joining our 2021 fall market update. I'm the Chief Investment Officer here at Wealth Management for Wealth Fiduciary Services, and we're going to give you an outlook of the economy, financial markets, as well as some key themes that we see unfolding in financial markets. So let's go ahead and get started here with the review of the markets and some thoughts on the economy. We'll start with the labor market, and we are still about 5 million jobs short of where the employment market should be relative to the pre-pandemic high. Those jobs have been slower to come by, but the recovery from the bottom has been relatively sharp compared to prior recessions. And as we see continued improvement, we believe the labor market should fully recoup in about 12 to 18 months. If we look at job openings at a record high, in fact, an update earlier this week, job openings fell to 10.4 million, but still relative to history, as you can see on this chart here, a record number of job openings, and that speaks to the strength of the economy going forward. That strength in the labor market has also translated into higher wages for individuals. This will have a couple ramifications. One, potentially causing inflation to last a little longer than anticipated, despite the transitory language insisted by Fed officials. It'll also potentially eat into profit margins for companies. We'll talk more about that later. Nonetheless, this also provides some benefits for consumers as we see stronger wages, but also a testament to the strength of the economy as wages begin to increase. If we look over to the business investment side of the economy, here too, we're seeing strong business investment. Here we look at durable goods orders, non-defense excluding aircraft, and currently trending at about a 10% annualized growth rate. When businesses invest in plant and equipment, that is a vote of confidence in their business, and therefore also speaks well to the strength of the underlying economy. So when you look at consumer spending, improvement in the labor market, you're seeing the economy continue to improve on a variety of aspects. And then finally, two other points I'd like to highlight: the ISM surveys, the ISM manufacturing, and then the ISM services. These are survey indices. Any reading above 50 indicates expansion, a reading below 50 indicates contraction, and readings below 44, 43 or so are indicative of recession. You can see that both of these metrics, both the manufacturing and the service sector, are above 60. That is about as high or as strong as you'll see on a historical measure, and that is indicative of roughly 5 to 6% economic growth. Both of these surveys, again, very strong. However, both also reveal, if you look at some of the comments in each, supply shortages, labor shortages having an impact and continue to be widely cited. So despite the fact that we're seeing a number of high-profile, strong economic reports across the board, reflective of a healthy economy, it's not translating into stronger economic growth for the third quarter. Why is that? And it's because those supply shortages, bottlenecks, and also labor shortages are not enough to meet the strength in demand. On the left is the consensus third quarter economic growth forecast from Bloomberg, which surveys a number of economists on a monthly basis to get their forecasts for economic growth, and that has been trending down since July. It was as high as a 7% reading, but now pointing to growth, or an expectation of growth, of just under 5%. That is a pretty sharp deceleration in just a matter of 3 months here. We'll know more about third quarter economic growth at the end of October. Another measure of economic growth, the Atlanta Fed GDP Now indicator, has dropped to just over 1%. This has been a pretty good guide of economic growth as well. The real number should probably fall in between that 1.25 rate to between 4.5 roughly for the third quarter. Again, we'll know more at the end of the month. But expectations have come down as it's become apparent that the supply shortages, bottlenecks are having an adverse impact on economic growth. Now, the flip side of this is that this could translate into stronger economic growth in the fourth quarter and also the first quarter of 2022. So we do not see it as a sign of a recession beginning to take hold again, but rather the recovery being delayed as supply meets up with stronger demand. Let's shift gears and move towards investment performance and talk about the third quarter and the year as a whole. The third quarter was a challenging one for investors. A number of asset classes had negative returns, and within the equity market, only the largest companies, the S&P 500, for example, had a 0.6% positive return for the quarter. A number of other asset classes, mid-cap stocks, small caps, all declined. Emerging market equities declined, even developed international. So it was a tough quarter for investors, generally seeing slight losses. On the flip side, on a year-to-date basis, performance remains very strong. So given the strength of performance since the low in March of 2020, a pause was certainly in order, and investors got that during the third quarter. We do think it's going to get a little more challenging from here, although we do think we'll see incremental gains in the equity market here going forward. Talk more about that in a moment. But important to put the third quarter in perspective. We still think it is prudent to remain diversified, remain invested, and these types of quarters are just part of normal market behavior. Speaking of normal market behavior, the month of September was a negative one for U.S. stocks globally. At long last, we had a 5% decline. Prior to the 5% decline, which was reached at the end of September and again in early October, the U.S. stock market, measured by the S&P 500, had not witnessed a 5% decline since October of last year. It's actually the 8th longest stretch without a 5% decline. And I like to show this charts to investors and clients that declines are a normal part of investing. This chart shows the S&P 500 going all the way back to 1980. The blue bars represent the full calendar year return, and the red dots represent the maximum intra-year decline. So you can see that although 3/4 of the years since 1980 have been positive, all of them, or almost all of them, have seen a fairly substantial decline within the year. And at 5%, that's still relatively modest so far in 2021. This may not be over. The market's attempting to stabilize. It may not be over, but again, important to realize that volatility is normal. Pullbacks and corrections do occur even in a broader upward trend for the stock market. Now, although the S&P 500 was down 5%, if you look under the hood, the damage has actually been a little bit more severe. This chart shows the percentage of S&P 500 stocks that are above their 50-day moving average. And what you see here is that in April of 2020 or March of 2020 was very low. That improved sharply. And then in April of this year, that measure peaked out again. And in April and May, that slowly started to decrease to where over the summer, the number of stocks above their 50-day moving average was less than 50%. So what that shows you is that the participation in strength in the market faded, and it was really those big mega cap technology companies, those biggest names in the indexes that were driving the gain. So sort of a stealth correction, which is evident here. So the broader market certainly fared worse than some of the popular indices. You can see the decline from the all-time high in the S&P 500 was 5%. For the tech-heavy NASDAQ, it was down 7%. And for the Russell 2000, which measures U.S. small companies, down 11% from its all-time high. But if you look at the average stock and its decline, this is all of the stocks within those representative indexes, you can see the declines were much more severe on average. So the S&P 500, the average stock was down 13, the NASDAQ down 15, and the Russell 2000 or small cap stocks were down 28% on average. Again, that's a big divergence, and it really shows that there had been some damage over the summer as investors worried about the trajectory of economic growth, worried about a new surge in virus cases. So a lot of damage has occurred, and that's one reason why we think that has already occurred, and it seems like the bigger names have been the last to really be adversely impacted by this sell-off. So do note that a lot of the damage has occurred, and I think as the market begins to anticipate better economic growth in fourth quarter and in the first quarter of 2022, we should see some broader market improvement. And as we look towards the fourth quarter, seasonally, this is the strongest quarter for the stock market. Since 1950, the fourth quarter has returned 3.9% on average, notably above the average return for the other 3 quarters of the year. The yellow dot represents the percentage of the time that there is a positive outcome. And here too, the fourth quarter stands out with a 79% positivity rate for the S&P 500. So history, this is a favorable seasonal part of the year for the equity market. So that little bit of a tailwind to help equities as we confront some mounting headwinds, which I'll talk about here in a moment. Let's talk about valuations and earnings, and the stocks remain expensive. No two ways about it. The PE ratio on the S&P 500, the dark blue line, remains elevated. It is at 21. It's actually come down this year due to the strength of earnings. They've been very, very strong. International equities have seen a similar phenomenon, but they remain more attractively priced relative to the US. Part of that is due to the stronger recovery in the US in terms of an economy. Both China and the US, the first to really recoup from the COVID pandemic. But we do maintain an allocation to international stocks because of those more attractive valuations and prospects for higher earnings. Speaking of earnings, we are at the cusp of the start of the third quarter earnings season. The expectation in the blue bar there is for a 27% increase for the third quarter. You can see that since the second quarter of 2020, earnings have surpassed or been better than forecast consistently since then, and especially the first quarter of 2021 and the second quarter of 2022, earnings came in much stronger than forecast. Just a really impressive result in terms of corporate earnings and how corporate America has responded. The third quarter presents some challenges in that we've had 2 big name companies, FedEx and Nike, talk about supply shortages, bottlenecks, and difficulty in getting labor as well. And they have decreased their profit forecast. So this will be an interesting earnings season to see if that expectation is met or not, and that might have implications for the trajectory of the equity market going forward. Our expectation is that we'll see mid-single-digit gains for the equity market over the next year. It still pays to be invested, and that these strong earnings will continue to provide ongoing support. So we'll continue to update that in coming months and quarters. One other headwind to be aware of for the equity market, and also why we think returns will be lower, the fiscal policy is going to turn into a drag. Certainly policy was incredibly robust in 2020 in response to the pandemic, also very robust due to some of the stimulus provided earlier in 2021. But in 2022 and 2023, the government is going to be spending less, which will be a little bit of a headwind for both corporate America and consumers. You can see here that spending as a percentage of the economy, as measured by GDP, is going to drop from 11.1% down to 2.7% in 2022. And that assumes that the entirety of President Biden's proposed $3.5 trillion spending package is approved. However, as I discussed this, Congress is already talking about a pared down package in the 2 to 2.5 trillion range. So still yet to be determined, but that number, that percentage of GDP from 2.7 likely to be lower, and therefore less help from the government for the economy going forward. Now, I wanted to shift gears a little bit, talk about some themes that we're seeing in markets and get circulated in the media. One is the discussion of the equity inflows, particularly for equity ETFs, and how strong they've been in 2021. And that is very, very true. Flows into equity and bond funds or ETFs have been into equity funds and ETFs have been strong, particularly for ETFs. But I think it's important to put it into context on where it stands relative to bonds. And on that note, bond inflows still dwarf the money that is going into the equity market. So I don't see that money going into equities is too much of a risk for the market, given what we've seen on bonds and continue to see in bonds. So it's important to have that perspective on equity flows. And when we talk about money and cash, still important to realize that there is a lot of cash on the sideline. This is Federal Reserve data from the largest U.S. banks. The gold line represents deposits. You can see the steady increase after the pandemic due to all the stimulus, and that continues to increase, albeit at a slower pace. whereas loan growth contracted for a while, has now finally begun to pick up. But that still shows you that banks are flush with deposits, and as a result, continue to have an abundance of cash. Money market assets on the right, we saw a slight decrease after March 2020, but still money market assets remain elevated, and that still points to additional funds that could be invested or spent by consumers. So there is a lot of cash, despite some of the flows that are talked about in the equity market. It's a lot of asset classes are expensive, and I don't think the data on flows should be misconstrued. Important to recognize the cash that is in the financial markets and in the economy. Now, another topic that is becoming quite popular and thought about in the media, that stagflation. Is it back? And the third quarter might turn out to be one that is stagflationary to some degree, depending on how much growth that slows. The US CPI inflation indicator was 5.4% for the month of September. If US economic growth does not exceed that, that would certainly be close to what people would call stagflation. I think it's important to remember that there is no formal definition of stagflation, and that most, I think, in the financial markets would categorize this as below average growth with above average inflation. And if I try to handicap it in the lower left by comparing economic growth as measured by GDP to CPI inflation, let's call GDP growth of 2.5% or less as slow, and inflation above 3% as high. And you can see there's not many years that fall into that range. The red numbered years highlight years in which were partial, or at least part of the year was in recession. So if you take out those recession years, it really shows just what a rare occurrence it is. But that's really what we're looking for in terms of trying to identify whether we're in a stagflationary environment or not. And that could be the case for the third quarter. But if economic growth rebounds in the fourth quarter, as we expect, and in the first quarter of next year, and inflation begins to slowly subside, then I think we'll see that stagflation not materialize outside of the third quarter. Another way to look at it on the right is to measure whether inflation, the gold line, is above annualized GDP growth there. And you can see just a few occurrences historically. So it is rare for it to happen, primarily a 70s and early 80s phenomenon, although there's been brief flashes at other points. In any case, it's important to realize that stocks are still the best hedge against inflation. They're one of the better performing asset classes against an above average inflation environment. And that speaks to companies' ability to often pass through price increases. Here, taking a look at surges in inflation or increases in inflation going back to the mid 80s, you can see the low in inflation as measured by the consumer price index, have the two dates, and then the low to high, followed by the change. And the change is anywhere from 2.4 percentage points to as much as 6 percentage points from July 09 to September of 2011. These are all some of the bigger peak or trough to peak rather increases in inflation, but you can see that the US equity market, as measured by the S&P 500, managed positive returns 5 out of those 6 occasions, with the average return fairly strong at close to 9%. So if history is any guide, stocks have still been the best hedge against inflation, and we continue to believe that going forward, and why investors should remain committed to an investment program for the long term. Now, compared to bonds, we certainly find stocks more attractive. One of the easiest metric to assess the attractiveness of high quality bonds is to look at the inflation adjusted yield of US Treasuries. In this case, we are looking at the 10-year Treasury yield. We call it a real yield when you adjust it for CPI inflation. And you can see that it is negative, just improved a little bit recently, but hit a negative 3%. That's the lowest inflation adjusted yield since the late 1970s, and indicative of a very expensive valuation for bonds. As inflation begins to decelerate, this will improve, but we're still looking at negative real yields for bonds, which are still supportive, not only for corporate America, but also for equities as well. So still an expensive bond market. We remain defensively positioned in our bond allocation with below average interest rate sensitivity. Not that we expect a spike in interest rates, but more of a creep higher. And to that point, if we look at the Fed funds target rate, both what the Fed has forecasted they'll do in terms of interest rate hikes, and then the market implied expectation as measured by interest rate futures. You can see that the market and the Fed are roughly aligned for 2022 and 2023. The market actually expects the first rate increase to happen late 2022, with roughly 3 rate hikes in 2023. But as you move forward, the bond market is, you can see the yellow bar is a little lower than what the Fed forecast. And that's basically the bond market saying that with an increased debt burden, it's not likely to see interest rates go that high longer term. So we expect interest rates to rise, albeit gradually, but not shoot higher to levels that might have been in the 5-6% type range. So important to have that perspective. Still a long way to go. It'll be a gradual progression. And on the right, the 2-year Treasury yield, which is most sensitive to Fed rate hike expectations, reaching a post-pandemic high of just over 35 basis points, extremely low on a historical basis and still well below the near 2% yield that existed just prior to the pandemic, but the sign that rates are gradually going to creep higher. So again, a defensive positioning in bonds warranted, with some allocation to more economically sensitive sectors like high yield bonds and corporate areas of the bond market. All right, that is all my comments on the economy and financial markets. Thank you for attending. We look forward to speaking to you again in next quarter.